Hello, and welcome to Portfolio Matters Weekly Markets Checklist, week 137. But before I get into it, I will read the disclaimer. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware we're discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. So due to scheduling issues, I will start and Richard will join us in due course. But before we get going, some housekeeping. Thank you to Rogue Trader for his work and our monthly Discord chat. I thought it was very useful and got some segments coming up based on that discussion. We do it once a month. Okay, news this week. Well, Japan has removed the explicit 1% cap on the 10-year JGB, although it says yield curve control will continue, but without an explicit price cap. As a result, Japanese bond yields have surged towards the 1% cap, but not yet gone through them. But the yen has fallen sharply and passed 150 to the US dollar. The Japanese government has also unveiled a $113 billion stimulus package to compensate people for the effects of high inflation, which seems extraordinary, adding more fiscal stimulus in an inflationary environment. So we had central bank meetings in the US and UK, both held rates. The FOMC held rates at 5.25 to 5.5%, but left the door open for the possibility of one further rate hike. We had a very good week in equity, bond, and commodity markets as markets started to price in a peak in interest rates. The Bank of England held rates at 5.25%, and it stated that it expects UK inflation to fall to below 5% this month, which seems rather a dangerous prediction. Let's hope they're right. Their credibility has taken quite enough of a knock this year already. And finally, last night in New York, Sam Bankman-Fried was convicted of fraud over the collapse of the crypto exchange FTX. So this is the Bank of Japan's yield curve control. Previously, they had a hard cap at 1% on the 10-year JGB. Now, they will no longer have the hard cap, although they will still intervene in the market to prevent yields rising too far. Everywhere, the market is now pricing in no further rate rises and rate cuts beginning at the start of Q2 next year in the case of the ECB, which the market expects to be the first central bank to start cutting. And this is rate expectations for the UK. And you'll see that in June, the market was expecting UK rates to peak at above 6%, which always seemed slightly delusional. Well, the dark blue line is expectations now, and the market is pricing in no further rate rises and rate cuts to start in Q2 next year. Now, as part of the Bank of England meeting, they also released economic forecasts for the UK for next year. And they downgraded UK economic prospects for the second half of 2023. So the light blue line is their forecast as of August. The dark blue line is as of now, and they now expect the UK to record no growth in H2. So this is their longer term forecast, and the red line is their current forecast. So the past performance of the UK economy has been revised up, but the future of performance looks very flat for the next few years, not much growth. They are expecting UK inflation to keep coming down. As I've said, they're expecting inflation to fall below 5% this month. But medium term, they're expecting inflation to take longer to return to the 2% target. Although the UK money supply is collapsing, which suggests an accelerating slowdown in both the economy and inflation. So the Bank of England is talking rates higher for longer, but if the economy slows in line with the falling money supply, then rate cuts could be sooner than that. Now, bonds had a good week, in part because the US Treasury announced fewer bond sales than had previously been expected. So it's now forecasting that this quarter it will only issue $776 billion of bonds against expectations of 852. And on to this week's economic data. So first of all, the UK. So UK consumer credit met expectations in September, but was down on August. That line looks pretty flat. Mortgage approvals keep on falling, and those are at lows only previously seen during the pandemic and after the great financial crisis. Mortgage lending was once again negative. So net, more mortgages are being repaid than taken out. And that meant net lending to individuals was missed expectations and was very close to zero. And as a result, the money supply contracted by 1.1% in September alone. So the UK money supply is falling, and that should hopefully mean inflation comes down. Surprisingly, the nationwide house price index actually rose 0.9% month on month in October, which meant that house prices only fell 3.3% year on year. So we know that building supply in the UK is now poor because a lot of house builders have cut back on their building due to fall in demand. So the lack of houses for sale in the UK seems to be supporting prices despite poor affordability. UK surveyors are reporting falling workloads. So we're seeing reduced construction activity in the UK. So in summary, UK money supply is falling, consumer credit is falling, construction market is falling, and bank lending is falling. So it looks like the UK economy is slowing towards recession, although the Bank of England is forecasting that the economy will stagnate rather than fall into outright contraction. We expect the economy to fall into recession as the lagged effect of higher interest rates starts to bite over the coming months. And on to the EU. So we had GDP numbers for Q3 and they were below expectations. The EU economy contracted by 0.1% in Q3, and frankly, I don't expect that to improve in the coming quarters. So the EU looks like it is already in recession. And year on year, EU GDP growth was 0.1% in Q3, which was below expectations and well down on Q2. We also had excellent inflation numbers in the EU. So CPI month on month in October was well below expectations at 0.1%. It had been expected to be 0.5%. The 0.1% October print was well down on both the September number and expectations, and that meant year on year, EU inflation is now just 2.9%. Again, well done on September and below. Now, there's a huge divergence, though, in the inflationary experiences of different members of the Eurozone. So Belgium has had deflation of minus 1.7% over the year to October, whereas Slovakia still has inflation of 7.8%. So the ECB has a very difficult job in attempting to set monetary policy for all these disparate countries. Pause, take a look. Netherlands also has deflation of 1%. Core CPI, though, was 4.2%, only slightly down on September and in line with expectations. Month on month, core CPI was around 0.2%, so that is much closer to the ECB's target, but core inflation is only coming down slowly. So the ECB is likely to keep interest rates high until core CPI comes back further towards target. We also had the Eurostat surveys of the Eurozone for October, and actually they weren't too bad. So economic sentiment only declined marginally in October from September and was ahead of expectations, although still below 100. So economic sentiment in the Eurozone is not good, but it's not really deteriorating much. Consumer confidence fell slightly in line with expectations. Inflation expectations declined and missed expectations, which is good news. Industrial sentiment declined, but was slightly better than expectations, still very much in contraction territory. Selling price expectations subdued. So in the EU, inflation's coming down, inflation expectations are coming down, and manufacturers and companies' inflation expectations are also very low. So it looks like the Eurozone inflation is coming back under control. Services sentiment was better than expected and actually rose on September, although it's quite poor by historic standards. The Citigroup Economic Surprise Index fell last week to minus 47. So the recovery in European economic data seems to have stalled, at least last week. So in some way, the Eurozone looks like it's already in recession, and we expect that the recession will only get worse from here as the lagged effect of the rapid rise in interest rates slows the economy further. The good news is that inflation looks well under control. And on to the US. So we had the Fed's favorite inflation measure, personal consumption expenditure inflation figures for September, and they were okay, but not great. So in September, PCE inflation came in at 0.4%. That was unchanged from August, but higher than expectations. Year on year, it met expectations at 3.4%. And you'll see that not come down in the last 3 months. So PCE inflation in the US is being persistent. Core PCE inflation was 0.3%, up on August, in line with expectations, and year on year was 3.7%, declining slowly, but still well above the Fed's 2% target. Super core PCE inflation, so excluding food, energy, and housing, is 3.2%, and that's on a 3-month annualized basis. So easing, but still well above target. Bad news for the Fed, the number of inflation components which are seeing price rises has ticked back up recently. We also had September personal income numbers, and they were disappointing. Month on month, personal incomes only rose 0.3% in September, down from August and below expectations. Now, we know that consumer spending was extremely strong in September, and that's confirmed by the numbers here. So despite disappointing personal income growth, personal spending rose 0.7% month on month in September, above expectations and up on August. So US consumers were spending savings in order to maintain and grow consumption, and that is unsustainable. We had the employment cost index for Q3, and wages rose 1.2%. And if you look at the chart, you'll see they are just not coming down. And that's worrying for the Fed. That is incompatible with the Fed's 2% target. So interest rates are going to have to stay higher for longer until you get some slack in the labor market and wage growth starts to come down. Benefits also stayed high and beat expectations. The good news was that the employment cost index did not rise as much as wages might imply because productivity rose. Now, later on today, we have non-farm payrolls in the US for October. The ADP numbers, which survey private employers, came out and they missed expectations, but were still decent and were actually above September numbers at 113,000 jobs created. There are very few challenger job cuts in the US. The October number was well below expectations, actually down on September. So US employers are reluctant to let workers go. We are seeing labor hoarding. And job openings actually rose in September from August, beating expectations. The quit rate was unchanged at still a very decent number. So US employees still feel confident in leaving their jobs and being able to find another one. So this chart shows the number of job openings to unemployed people in the US, and you can see that there are more job openings than unemployed people to fill them. So the labor market in the US remains very tight. We also had the ISM PMIs, manufacturing PMIs, and they were disappointing. So there was a sharp drop in the manufacturing PMI in October. It had risen in September and it's now falling back down, and that is a bad number. And only 11% of US manufacturers in the ISM survey reported growth, and that is a very poor number. Only seen at the bottom of the pandemic and after the great financial crisis. The employment index dropped into contraction, so US manufacturers now report they are letting people go. New orders also dipped sharply. Prices paid ticked up slightly, which is not good news, but still remains below 50. Construction spending in the US continues to grow, up 0.4% in September. And the August number was revised up to 1% from 0.5% previously. So despite very high interest rates, the US construction sector continues to grow. The Case-Shiller house price index grew again in August, meeting expectations, and year on year up 2.2%, despite an enormous rise in US interest rates and mortgage costs. The US housing market is just defying gravity. Total vehicle sales dipped slightly in October, but were better than expectations, and that is a decent enough number, although the trend is down. We also had the Dallas Fed Manufacturing Index that dipped in October, in line with the ISM. The Services Index, that is worrying actually. So that shows a sharp deterioration in services in the Dallas Fed's area in October. Now, we're awaiting the ISM non-manufacturing PMIs. They come out next week. The Chicago Business Barometer deteriorated only slightly in October, but missed expectations. And the Conference Board Index of US consumer confidence was actually better than expectations in October, although down on September and above 100. So US consumer, according to this survey, not too bad, actually. Red Book retail sales year on year. Reminder, this measures retail sales in the same store versus last year. And that grew 5.3%, still growing year on year. The 30-year mortgage rates dipped slightly, but remain very, very high and close to 8%. And as a result, the number of mortgage applications continues to fall and is at lows not seen in the last 25 years. Initial jobless claims ticked up, but that is not a very worrying number. That's still well below the highs of the summer. What is concerning is that continuing claims have been rising sharply, missing expectations, and that implies that people out of work are struggling to get a new job. The New York Fed's weekly economic GDP estimate shows that they think the US economy is growing just fine at about 2.3% year on year and showing no signs of deterioration. In fact, that number is better than last week. And the Citigroup Economic Surprise Index also ticked up. But the Atlanta Fed's GDP Now estimate for Q4 was revised sharply downwards to 1.2% from 2.3% this week. And this is what the GDP Now estimates for the year therefore look like. It is volatile, and this has happened before, but it seems extraordinary you would have had such a sharp deterioration in the US economy over the last couple of weeks. It suggests either that Q3 GDP estimates are too high or Q4 estimates are too low. So in summary, US inflation is falling, but frankly not as quickly as the Fed would like. Employment costs remain too high and the US jobs market too tight. Expect the Fed to keep interest rates high until it creates some slack in the labor market. The ISM manufacturing PMI for October showed a sharp slowdown, but as yet, the GDP estimates and the economic surprise index don't really seem to be showing much sign of a slowdown. And on to China. Well, we had the PMIs out and they were not good. So the National Bureau of Statistics manufacturing PMI massively missed expectations, coming in at 49.5, i.e. in contraction, versus expectations of 50.2 and down on September. Non-manufacturing also fell, missing expectations and only just in expansion territory. And that is a very poor number by historic standards. So the general PMI fell to 50.7 in October, well down on September, and a big miss compared to expectations. Expectations were that the PMI would increase, and it fell sharply. Now, the private sector Caixin manufacturing PMI also showed a sharp contraction in manufacturing activity in October, although it didn't show a contraction in services activity. which met expectations and actually grew compared to September. But that meant the Caixin General PMI also fell to 50, missing expectations and well down on September. So in summary, the PMI data coming out of China suggests that the economic recovery there is faltering. Okay, and onto one chart. So we've talked many times about how interest rates impact the economy via long and variable lags. And this is a chart which shows in the red and light blue lines UK quoted mortgage rates. But in the UK, most mortgages are either 2-year fixed or 5-year fixed. So most homeowners don't actually experience those higher interest rates until they come to refinance. And so the black line here is the weighted average interest rate on mortgages outstanding in the UK. And you can see, and it is slowly picking up as every quarter around 400,000 UK homeowners have to refinance their mortgages onto the higher rate. So you can see that higher interest rates in the UK take some time to feed through to tighter financial conditions for households. So over the coming months, as more and more people have to refinance their mortgages, so the black line will start to creep up towards the red line, and UK households will have to spend more on their mortgages, which will reduce demand, and that should slow the economy further. And onto the UK labour force survey. Last week, we discussed how the Office of National Statistics were having trouble with their unemployment numbers. And this is the response rate for the labour force survey. And you see that a decade ago, they got about 50%. And sadly, now they're only getting about 15%. Hence, they have decided the numbers are unreliable and they have moved to new experimental data using real-time PAYE and unemployment claims data. But the trouble is they are getting very different results depending on which survey they use. So the pink line is the labour force survey, which they've now abandoned, and it was showing that the recovery from the pandemic in terms of employment was very weak and fading again rapidly. But if you look at HMRC payroll data, then you get a much more optimistic picture. The dark blue line shows a very strong recovery from the pandemic, and actually UK employment being around 5% higher than in January 2015. And the workforce survey is closer to the HMRC payroll data. So if you're the Bank of England, which set of figures do you believe? If you look at the pink line, then the UK jobs market has not done well and is fading quickly. If you look at the dark blue line, then the labour market is tight and not really declining. UK statistics, sadly, are in a bit of a mess. And on to inflation watch. Well, so we had numbers out for Japan this week. So CPI in Japan fell to 3%, core to 2.8%. We had interest rates in the UK and the US, and they both kept them unchanged. The next ECB meeting is in mid-December, and the same for the FOMC. US trueflation has ticked back up slightly to 2.4%, but that is pretty close to the Fed's target. In the UK, trueflation about 6.3%, and the trueflation data seems very lumpy for the UK. Now, Goldman Sachs have revised down their US core PCE inflation forecast for the 2.4% for December 23, compared to 2.6 previously. Everywhere, it seems inflation is slowly fading. Now, if we look at wage inflation in the US, and wages obviously are the main component of demand, so sticky wage inflation equates to sticky inflation. So private sector wages are falling quickly. What is supporting wage growth in the US is actually the public sector. So public sector wages are currently growing 7.8% year on year. So if the US wants to get inflation under control, it needs to rein in public sector pay. The good news is that PMI output prices are continuing to fall, and they tend to lead CPI by 5 months. So CPI hopefully should continue to fall in the coming months in the US. And the same is true in the EU, but even more so. And this chart shows US M2, the money supply, and it is falling year on year at 3.6%. And that is unprecedented in the last 60 years. If inflation is everywhere and always a monetary phenomenon, then the US should soon be seeing deflation rather than inflation. Now, returning to the UK, this is the ONS's various estimates of wage growth. So the light blue line is the ONS's estimate, and it thinks that wages are growing above 8%. Independent surveys, private sector surveys, show much weaker pay growth. So the dark red line is the Indeed index of online job adverts. The pink line is the Bank of England survey of employers, and the dark blue line is the expert HR survey of employers, the basic pay award. And so you can see that other surveys have weaker wage growth than the ONS, but I would suggest all those numbers are still way too high to be compatible with the 2% target. So in summary, inflation is falling everywhere and is expected to keep on falling. However, wage inflation is too high on both sides of the Atlantic to be compatible with the 2% inflation target. Therefore, interest rates are going to have to stay high until we create some slack in the labor market. And on to the US housing market, and special thanks to our Discord viewer, Wayne J, for sending me this. So we know that US house prices have been climbing again, which seems absolutely extraordinary given the rapid rise in interest rates. So the average 30-year mortgage rate in the US is approaching 8%, which means that housing affordability is at an all-time low. So to buy the median house with the median salary, the median worker would have to pay out 44.6% of their salary on housing costs. So housing in the US just seems unaffordable, but house prices are rising. And new home sales are actually up substantially year on year. What on earth is going on? So the yellow line here is new home sales, which have grown substantially over the last year. But home buyer traffic, i.e. the number of people expressing an interest in buying a new home, has collapsed. What on earth is going on? Well, one of the ways that home builders in the US are supporting demand is by cutting prices. Now, this may be a function of them building slightly smaller houses, but the median price of a new home sold in the US has actually fallen by 16% in the last year, which is substantial. and they are offering discounted mortgages to home buyers. So they are lending home buyers the money to buy new homes at a subsidized rate, which will compress their margins. But that still begs the question, who is buying all these houses, given that we know that home buyer interest has been falling? Well, it probably isn't investors, because investors have stepped back sharply, down 45% from their peak in Q2. And home buyer interest is falling once again as the US economy slows and mortgage rates continue to rise and affordability is awful. So the question is this sustainable? So far, US home builders have performed much better than expected and grown their sales by essentially cutting the price of houses by around 16% and subsidizing mortgages for new home buyers. But eventually you would think that the drop in house buyer interest will start to limit their ability to keep doing that. Watch this space. So far, the US housing market has continued to defy gravity. I am mystified. And onto the FTSE 250. So during the week, we had a Discord discussion online with Rogue Trader, and in it, he had a chart of the FTSE 250. And this is the FTSE 250 total return index. And you'll see that since its peak 2 years ago, it's down 22%. And that includes the 3 or 4% bounce we've had this week. And actually, its performance is much worse than that in real terms, because we have had a reduction in British purchasing power of around 30% since 2020. FTSE 250 in real terms is down about 40% from its peak, which is a huge fall in its real value. So if you've held either the FTSE 250 or AIM, then in real terms, the value of your savings has declined by a great deal. And we've talked previously about, in the long term, how the vast majority of the value of the stock market is in larger companies, i.e. successful companies. So long term, you want to be holding large companies rather than mid and small cap companies. And on to Recession Watch, Richard.
Thank you, Keith, and apologies for joining late. The Fed funds rate has been sort of chasing to catch up with inflation, and now inflation has fallen through the Fed's fund rate, actually giving real interest rate for the first time in, well, apart from a little bit in the late teens, the first time since about 2008.
Yeah.
So the Fed is not moving interest rates in either direction at the moment. So we're going to continue to have a real interest rate in the US for some time to come, I guess.
Yeah. So in real terms, interest rates are becoming more restrictive.
Yep. And high yields, we mentioned this last week, that the high yield defaults seem to be just picking up a bit. And that trend is continuing. So high yield defaults continuing to increase. And I guess one of the reasons for that is that if you borrowed high yield at a relatively low yield and it comes into being refinanced, and you have to refinance it at a higher yield, you can't necessarily afford it. And also, quite a lot of high yield debt was sent to was given to businesses who actually don't have free cash flow in order to pay it off, despite all of the Fed tightening. And as we continue from last week, really, the US consumer spending power seems to be pretty powerful. And as you can see, the consumption there is by far the largest part of the quarter 3 GDP growth.
Yeah.
So how does the US consumer get tapped out? Well, we don't know, actually.
Yeah, well, We saw earlier, I showed that US income growth in Q3 was disappointing, but US spending growth was much higher. So US consumers have been dipping into savings, and all this just seems unsustainable. And I really wonder whether those numbers for Q3 growth were true and will be revised downwards.
I mean, it is well, because we're talking real numbers, aren't we? So and everybody says that the pandemic savings have gone.
Yeah.
Credit card rates. Do you know, I saw an advert yesterday for American Express. I was on the train to Birmingham and back, and it says if you spend money on it, it will say all the glamour of American Express. At the very end, 88.8% APR.
Marvelous.
I guess if you pay it off every month, I don't know, or do they charge for the month? I have no idea.
Good business for them.
Absolutely, yeah. So Bloomberg forecasts that US GDP growth is going to fall sharply in Q4 and to become slightly negative. And I say Bloomberg is following Portfolio Matters in that regard. We've been saying that for months.
We have, but I mean, frankly, we've been dead wrong. And actually, Richard, I'm skeptical about this because we're already 1 month in to Q4. Yeah. And so, in order for Bloomberg to be right, you'd have to see a very sharp slowdown. Now, to be fair, the Atlanta Fed's GDP now forecast fell sharply this week, but still to 1.4%. So the US economy may be slowing, but I think it'd have to slow really sharply from now to get to zero for Q4.
And there's still a lot of money going into the economy from the Inflation Reduction Act and the CHIPS Act, or whatever it's called, which is all boosting GDP.
Yeah.
And strong Q3 does not mean that there will not be a recession, absolutely. And this is a chart that shows that strong GDP growth often occurs right before a recession. It's almost like our last hurrah, isn't it, Keith?
Well, yeah, but it's inevitable in that, you're basically using up all the final spare capacity in the economy.
Yeah.
And so recessions always start when the labor market is tight and the economy is doing well. It's just that then the economy is running up against hard constraints.
On the other hand, you can't therefore predict that just because you've got strong GDP growth, you're going to have a recession.
Yeah, absolutely.
So job postings. This is a job postings dashboard. It's actually rather prettily coloured, isn't it, Keith? And pink is, actually, most of it seems to be -9 to -14%. This is a fall in US job opening year on year. So most of the US is in that -9 to -14 range. And none of it appears to be in positive territory.
Yeah. So this is a new data source I found this week. I thought it was really interesting because the JOLTS job openings, rose this month in October. And this website, which collates new job postings, shows actually the labor market in the US is continuing to weaken.
And presumably it collates them off things like LinkedIn and Monster or whatever it's called, and other job websites. And we've got anxiety about job cuts is rising in the US. So the population is getting concerned that unemployment may become an issue for them, presumably. Yeah. And that should feed through, you think, into a feeling of insecurity and reduced consumer spending. Yeah,
though the quits rate was unchanged this month.
And this is a chart showing the credit canaries. So CCC rated corporate debt. Euro CCCs, I have to say, what are they? 18, 19 percentage points is the credit spread. Is that over base rate, Keith?
Yes, it is, yeah.
So that means that they are at around about 21 or 22%.
Yeah.
And in the US, it's sort of ticked up a little bit, but it is not of any great note, I would say, right now. It's fairly easy. But Euro triple Cs look like they're in some serious trouble.
Yes, the market is becoming very concerned about the European economy. It thinks that there's going to be a lot of defaults. And frankly, I think it's difficult to disagree.
I don't see that it can be avoided. This is a graph showing the unemployment rate in California and the unemployment rate in the United States. And the question is, does one, i.e. California, lead the US? But if you're interested in me there, we are only right at the very turn, possibly, of this, probably a turn actually. So it's, if we're heading into a recession, we're going to get recessionary type unemployment rates. It's got a long way to go, hasn't it, Keith?
It has, yeah. And so the kind of, well, the Twitter legend is that California leads the rest of the US. And looking at it, yeah, it's plausible, but it may also be, an internet myth. But you're right. It's got a long way to go. I mean, previous peaks have been around 10%, and so the rise so far has been very small. But whenever there is a rise historically, it has tended to be sustained.
Yes.
So
yeah, that's true, and there is definitely a rise there.
Yeah.
Only this is what I talked about just a few minutes ago. According to this, only the top 20% of US income distribution still have any excess savings from the pandemic, and even they are falling. And the bottom 20% have less excess savings than they had in the pandemic, and the 60 to 80% have neither more nor less. So that's falling steadily, isn't it, Keith? And that's,
yeah,
but also how much do the plus 20%ers, top 20%ers contribute to consumer spending in the US? That number we were looking at.
Yeah. Well, we do know that, credit card default rates are rising.
Yeah.
So this all makes sense. But we also know that this week, so we also know that this week, luxury goods makers and luxury drinks makers such as Moet, Vuitton, Hennessy, etc., all reported poor sales. So it doesn't sound like actually the top 1% are doing very, very well either. They seem to be pulling their horns in.
Yeah. And startups shutting down. Highest number of shutdowns yet. And so this goes back about 5 years. And what we can see is that lots of startups are only viable at very low interest rates. And now the rates have risen sharply. Many of them are going bust, either because they can't, if they've got floating rate debt, can't afford it, or they can't refinance because they have to refinance at a much higher price. Effectively, what's happening here is that the free good that was money,
yes,
is no longer free.
Yeah. Well, at 0% interest rates, Richard, you can basically the value, or essentially what 0% interest rates are saying is that there's nowhere good to place your money, and you can speculate on, new whizzy piece of technology. But then suddenly when you're getting 9% on a corporate bond, why would you invest in or gamble on an unknown startup when you can get 9% a year? I mean, if it takes you 8 years for get your money back on a startup, then, if you put it in 9% in a corporate bond, you have made over 100%.
Precisely, yeah. Very difficult environment for startups and small companies.
Yes, and we both have a portfolio of startups.
No, yes. We've got a few contradictory data points, as ever, I would say. So September GDP was very strong, when all of this data suggests that the consumer is cutting back on discretionary expenditure. So what's going on here? It's very difficult. I mean, really, you need more data points, don't you, Keith, to work this one out?
Well, honestly, I think we've got enough data points. It's just they all contradict each other stupidly. Yeah. I mean, so the number of seated diners fell 7% year on year in September. And yet, And discretionary retail traffic was fell best part of 10%. But according to the GDP numbers, the US consumer was really strong. I mean,
I think
what's going on?
I would guess probably, I don't know how sophisticated this data is, but seated diners, where is it? What sector is it falling in, and what contribution is that to? So if it's falling in the people with least money who spend least when they sit down for a meal, then the contribution will be much less than if it's sort of across the board.
Good point.
And the number of searches for "we can't pay our credit card bill" has hit an all-time high. And I suspect these things have a fair degree of relevancy, actually, because people do now turn increasingly to Google to find solutions to problems.
Yeah. No, so this is the first time I've used Google Trends. It was very interesting, actually. So you can.
Did you type in this yourself, Keith?
Yeah.
Well done. That's good.
Yeah. So, yeah, interesting.
It's a little, almost an exponentially shaped curve, isn't it?
Yeah.
Interesting to see how that progresses over the next few weeks and months.
Well, you said again, consumers. The actual hard data show the US consumers strong, but according to this chart, this is over the last 2 years. You've had consumers increasingly concerned about paying their credit card debts.
Yeah.
So, again, contradictory data. So
the Evercore ISI company survey shows that US corporations are becoming more pessimistic. Actually, they're becoming more pessimistic for quite a long time now, and their pessimism is at the average level of this survey.
Yeah, but again, downwards momentum.
Definitely, yeah. And the US money supply is contracting, which historically has meant a recession. And that is just sort of a fact, really.
Yeah. I mean, this data goes back to the 1830s. And actually, it's very rare that you have negative year-on-year money supply growth.
Yeah.
And I think looking through this, I don't think there's ever been a period when you haven't had a recession.
I don't think it has. I'm just scanning through it. Yeah, it's sort of baked in on that basis, isn't it? Unless something's completely changed. So no one is interested in recession stories. So, this is a number of stories mentioning recession and inflation, and basically nobody cares.
Yeah.
Problem solved.
Yep.
And which sounds like it's a harbinger for it to come running out like a train rushing out of a tunnel, doesn't it?
It does, yeah.
Germany, unemployment and the IAB labour market barometer. The barometer is actually moving up pretty sharply, and unemployment changes are positive, but not sharply positive, and not currently showing a particularly strong uptrend. So interesting with the IAB barometer is predicting. I mean, I just feel that the knock that has hit, particularly Germany, but Europe generally in terms of increased energy costs, I don't think we've really seen the impact of that yet. And I think we will see it.
Yeah. There wasn't space this week, but next week I am got a chart showing German primary energy consumption, and it's absolutely extraordinary. It's fallen by about a third over the last 2 years.
Indicates a significant reduction in industrial activity, doesn't it?
Yeah, absolutely. And you're right. I mean, you'd surely expect big increases in unemployment so far I've had labor hoarding, but at some stage, it's companies just can't keep hold of labor as their profits fall too much.
Exactly. You can tighten up your costs, you can reduce costs, you can make sure everything's running as smoothly as possible, but if the situation continues, you have to then start shedding labor.
Yeah.
Which you don't want to do if it's skilled labor, obviously. And UK corporate insolvencies at the highest level since the GFC. And this is per quarter, I think, isn't it?
Yeah.
1,000 per quarter I read in the FT. And that's that's a very steep, continually steep rise since 2021.
Yeah, but we haven't really seen big rises in unemployment yet. I mean, based on this rise in bankruptcies, and we've seen rises in bankruptcies in both the US, Europe, and the UK, but so far the rise in unemployment has not been that high, suggesting that a lot of people kind of see that an insolvency is coming and find a new job before the insolvency actually hits, so that insolvency don't create that many
and also, I think this is skewed towards smaller companies. Then the absolute employment impact is quite small.
Yes.
But it is also, it is not linear. It becomes exponential, doesn't it, at some point, Keith?
Yeah.
The knock-on effect of the unemployment.
Absolutely. So, reminder, we think that recessions occur when you get a negative feedback loop. So people become unemployed and then they cut back their spending, which means that other companies get lower revenue and they also cut back. And so far, we haven't seen that negative feedback loop really kick in anywhere.
So we can summarize this really by saying, I think the labour market appears to be slowing.
Yeah.
Falling job adverts, but that contradicts the jobs report. We're still puzzled by the strength of the US consumer. This big GDP print, which was mostly fueled by consumption, got rising credit card default rates, and we've got rising positive rates because of falling inflation. But the real impact of rates at the moment isn't whether they're positive or negative, it's the absolute level that has risen so hard, so sharply. But we think, as we have been saying for months, that the economic slowdown is coming, and I think it's coming soon now.
So quickly on to wind turbines. Now, this week we had the good news in that the Seagreen offshore wind farm in Scotland went fully live, and it has 114 10-megawatt Vestas wind turbines, which have a rating of 1.1 gigawatts, and that's enough to power 1.6 million homes, which is just astonishing. But the project took 14 years to develop, most of which was planning, permissioning, and overcoming legal challenges such as the one from the RSPB. Actual construction only took 3 years. And the size of the wind turbines they're using is just absolutely extraordinary. So the Vestas wind turbines have a blade diameter of 164 meters. So a football pitch is about 100 to 110 meters. So the blade diameter is about 1.5 football pitches, and each blade weighs between 33 and 35 tons. This is a picture of the, what do you call, the stanchion that holds the wind turbine up, and you can just see the size of it. Now, although we are investing a lot in wind capacity, offshore wind, the dark blue line is expected wind turbine installations, but we are not installing anywhere near enough to meet our net zero targets. And frankly, I think we're unlikely to meet even the base projection, because over the last few years, wind farm developers have seen their costs rise by 40%. And the FT had a breakdown of the increase in costs. So margins on installation have risen. Everyone else, particularly turbine manufacturers, have seen poor margins over the last, this is for 2022, worse in 2023. And the problem for wind farm developers is that they've seen their costs go up, but the wind farms they're developing, the prices were fixed years ago. And so higher costs now versus fixed income means that they're abandoning projects which are now no longer viable. So this week, Ørsted, the Danish wind farm developer, abandoned the development of 2 wind farms in the US and recorded a 4 billion impairment charge. Its share price fell by 26% on the day, and its share price is now what, a fifth of its peak.
I just wonder whether Ørsted can actually afford 4 billion.
Yeah.
And bankrupt. I don't know. It's
Well, I agree, Richard. And Siemens Energy, we've talked about previously, has problems with its Gamesa wind turbine subsidiary, and its shares are down 63% over the last 5 years. And again, down, what's that? 70% from or more from peak. But the recent rise in the costs of offshore wind are expected to fall over the coming years as there are economies of scale and wind farm developments get cheaper. The problem is that the current rise in costs mean that a lot of current development is uneconomic. And so you're seeing in the UK, the most recent auction attracted no bids. Richard?
Well, the other problem with that then, Keith, is that the economies of scale won't be forthcoming.
Yes, absolutely. And as a result of all this, the red line here is the MSCI Alternative Energy Index. And as we warned on this podcast, alternative energy has much lower margin than traditional energy. And so you can now see that investments in traditional energy have done much better than investments in alternative energy over the last 10 years, and particularly over the last 3. So all this adds up to wind farm developments which were given the green light in the last few years not being very economic and being abandoned. In particular, it takes a long time to develop these wind farms. And so higher interest rates mean that their financing costs have shot up. So falling wind farm developments are likely to lead to further pressure on wind turbine manufacturers and the entire supply chain, and they should probably be avoided as investments until we at least see a bottom. And on to Japan, Richard.
Thank you, Keith. So Japanese inflation, bearing in mind the Japanese are still holding their interest rates at 0.
Yeah.
I'm sure we're going to come on to in a moment, but Japanese inflation fell to 3% in September, having risen to 4%. And the Japanese government is continuing to do QE, as it has done since...
well, forever. But, this particular chart is from 2022 to now. It just shows they're continually doing it.
So they are continuing to do QE, the only major central bank to be doing so at the moment. And so here's Japanese core inflation, which is 2.8%, fallen from 4%. And Japanese government bond yields have surged from 0 or minus 0.5% to minus 0.25% to all the way up to 1%. And so negative real interest rates of around about between 1.5% and 2% in Japan. Japan is a real outlier in terms of the management of its economy.
So I'm amazed that real yields in Japan are still very firmly negative. So minus 2%. Everywhere around the world, we've had a surge in real yields, which have now gone positive.
Yeah. Well, I think is the central bank even more trapped than other central banks in terms of the vast amount of debt, government debt, which is 2.5 times GDP.
Yeah, but the Bank of Japan is very successfully suppressing yields.
Yeah, it is. It is indeed, but the currency is not enjoying the experience, is it?
Yeah, but you'd expect, because so this chart shows the yen, and it's fallen from close to 100 only 3 years ago to 150 against the dollar. So the yen is worth a third less.
Yeah.
And you'd expect that to have fed through to massive inflation, but it hasn't. I mean, inflation has been lower in Japan than it has in the UK or the US. It's extraordinary.
It is, isn't it? I mean, I think, and I can't hazard a guess as to why Japan imports an awful lot of its fuel.
Yep.
Particularly since it shut down esse nuclear fleet, although it is reopening those now. So obviously oil has gone up, or price of imported oil would have gone up significantly due to the weakness of the yen. I'm guessing it also imports a lot of other things a lot of other goods that it needs. So I agree, Keith. It's unfathomable. It's not really following the rules that one would expect it to follow, is it?
Mm.
But if this trend continues, then the yen is going to go to maybe 175.
Yeah.
Don't invest on that basis, please. But if it goes to 175, then you're getting on for 100. Well, it's a 75% fall from where it was 3 years ago, and surely that has to damage the economy.
Yeah, but also when we talk about the topics, performance of the Japanese stock market later, it obviously has done very well. But if you're an overseas investor, you won't have done well out of that because the currency has more than offset the rise in the stock market.
Yeah. And Japan's fiscal deficit is still very large, and it's even worse than the UK's deficit, actually. It's 6.4% in the most recent in 2022, and but it does appear to be able to sustain these. And you would say, wouldn't you, at some point this becomes unsustainable, and you would have said that in 2000.
Yeah, no, it's been running an absolutely extraordinary fiscal deficit for 30 years now, and the Japanese government, as I said earlier, has just announced a 113 billion stimulus package to compensate Japanese citizens against the effects of higher inflation, which seems extraordinary.
It does. So, I mean, in summary, we're saying is they've got continuing QE. Inflation is actually quite low, never really went particularly high, and is falling. The yen is declining, and one would assume it's going to continue to decline. It's been doing this for 30 years, and is it ever going to break?
Well, we've talked before, Richard, about the effect of declining demographics on inflation. And so there are two separate arguments. The first argument is that an aging population means that there are fewer workers, and elderly people who have resources then have to bid up for the labor of the shrinking working age workforce, and that should be inflationary. Or the alternative argument is that old people, they consume less. There's no need to invest further in new manufacturing because actually manufacturing is declining, and therefore higher an aging population should be deflationary. And in the case of Japan, the experience is it is absolutely deflationary. I mean, the fact they've been running this fiscal deficit funded by printing money for 30 years, and they are frankly struggling to get inflation, is just extraordinary. I would have thought in any other country you'd have had a hyperinflationary crisis by now, but I've been wrong for the last 25 years. And on soft landing watch. So Richard was talking earlier about the IRA and CHIPS Act, and this is the expected impact of those US government programs. And you can see that it is expected to keep on growing over the next few years, and that should support economic activity in the US. And The consensus GDP forecasts for the US are very much for a soft landing. So we know that Q3 was absolutely extraordinary with plus 4.9% GDP print. And that's expected to slow to around 1% in Q4 and then bottom in Q1 next year. But the consensus forecast is that we will have a soft landing and the US economy will never fall into contraction, supported by the fiscal deficit. Now, the fiscal deficit has shrunk in the last couple of months as student loan repayments have restarted, but that is still a historically very high number. Bottom line is the US economy is slowing, but the consensus is very much that we're going to have a soft landing. They always say that, is what I'd say, but so far they've been right. And on to other charts, Richard.
Keith, production of oranges in Florida and has declined precipitously since 2014 and down about 80%. And I think the disease but also, basically lack of water, isn't it, Keith?
Yeah. But the result
is rocketing orange juice prices. This is over the last 2 years.
Yeah, I know. And it's very difficult to inflation in the UK has been so extraordinary. It's quite difficult to disaggregate the rise in orange juice prices from the rise in your container of orange juice. But I had personally consumed grapefruit juice, and I know that's up over 50% in the last few couple of years.
I didn't think marmalade would be up as well, wouldn't you? I'm not being facetious, but anything that has oranges in it, would have been affected. Duck in orange sauce. They did that on MasterChef last night. The US chart showing the US federal deficit in the 20th century, so obviously the wartime peak in the 1940s. The deficit is it's undergone a bit of a step change, hasn't it? Effectively, we had that peak in the 1980s, and then this peak is as a percentage of GDP is much bigger, and it's not declining.
Well, that trend just looks awful. So somebody sent me a Morgan Stanley report on the US fiscal deficit, which I aim to read this weekend and do something on next week. But the bottom line is that it looks like the fiscal deficit is not going to increase next year. And so this year, remember that change in GDP equates to a change in government spending. So the change in the deficit this year, the increase in the deficit has supported US GDP growth. Next year, even if the deficit remains where it is, that means the fiscal impulse will be zero. And so you can keep on running a big deficit, but it will not increase GDP growth. Thank you, Richard. On to good news. And actually, we have good news this week. So proper good news. This is from the FT, who had a special report on dementia. And dementia has actually been undershooting forecasts. So despite an aging population, the incidence of dementia has fallen by 13% over the past 25 years. So as people got older and older, we're expecting the rate of dementia to keep rising. In fact, it hasn't, it's fallen. And the explanation appears to be improved cardiovascular health. So what they are discovering is that better cardiovascular health means the brain gets better blood supply. And even though they are still seeing the plaques in the brain, which they considered previously to be a key marker of dementia and Alzheimer's, they're not seeing the rate of dementia increase at the rate they would have assumed. And it seems that better blood supply to the brain is protecting people against dementia. So that chart shows the rate of cardiovascular disease in women, and you can see it's fallen sharply over the last 30 years. There's a very similar pattern for men. So bottom line is, to protect yourself against dementia, you need to do some exercise.
Easy.
And on to equities, Richard.
Thank you, Keith. So the FTSE All World Equity Index had a good week, actually, last week, up nearly 4%.
Yeah, extraordinary.
And that included the FTSE All Share, which is up nearly 2%. And the Euro Stocks is up 2.3%.
Yeah, the Euro stocks, we know the European economy is doing poorly. And so the fact is up on the year, 4.2%, I find absolutely extraordinary. It seems to be heading for quite a deep recession. We had Q3 GDP numbers out and they were minus 0.1. So I think the Eurozone is actually already in recession.
And with the increased interest rates.
Yeah.
So then we have the S&P 500, which is up 4.4%, 12% in the year to date. And the NASDAQ up 5.5%. And I think the S&P 500 and the NASDAQ are mostly being driven by these big tech behemoths.
Yeah.
There's the Russell 2000, which had a good week too, but it's still in its downtrend.
Yeah, and down 2.7% on the year.
The Hang Seng up 1.2%, but down on the year. The Topix up 3%.
Yeah. Well, that's the flip side of the fall in the currency, isn't it?
Yeah, exactly, Keith. So, and actually since March 2023, it's up probably about 25%, isn't it?
So since March, it's up about 15%,
Okay,
23% on the year.
Yeah. Bitcoin has leveled off for a little bit, 1% on the week, but up nearly 110% for the year to date.
You've seen that Sam Bankman-Fried has been convicted.
Yeah, likely to be jailed forever, I understand.
Mm.
And we had a nice time while he was making hay, didn't he?
Yeah, well, not enough of one, I think. Lying on a beanbag in his office. I mean, if I'd had $1 billion, I would have had a bit more fun than that, I think.
Well, you'd have changed your identity, Keith, and disappeared, I suspect.
Yes.
In fact, we know Keith by an entirely different name from a previous month.
Yeah, if I had $1 billion, I wouldn't be doing this podcast. Anyway.
So the pound against the dollar, it's been around about 120 for a couple of months now. And the euro against the dollar is roughly behaving in the same way as the pound. And the dollar index is roughly behaving the same way as the pound and the euro. And the other major component of the dollar index is the yen, I believe.
Yeah, but the rises have stalled.
Yeah.
So I take that to be that the market is no longer expecting the US to keep on outperforming the rest of the world economically. And so there won't be further rate rises in the US. Yeah,
that makes sense, Keith. And then we have the VIX, which has fallen all the way back to 15.7.
Just extraordinary. Absolutely insane. Yeah, that is, the market's basically thinking there's going to be very low volatility. And actually, we've seen enormous volatility.
Yeah. Stocks outperforming bonds when unemployment is falling. And unemployment is starting to rise, which makes you think that bonds might start to outperform stocks. Yeah.
No, I think this is a really important chart, actually, from John Authors of Bloomberg. What it shows is the relative performance of equities over bonds in the dark green line versus the unemployment rate. And the two are very well correlated. And so when unemployment starts to rise, as it is now, bonds start to outperform equities, he says, hopefully. Okay, so after the close last night, we had Apple reporting earnings and revenues declined by 1% in line with expectations. but products, which are their main source of revenue, actually fell 5%. Now, they beat earnings expectations because their margins rose to 30%, which is just extraordinary. But revenue in China fell more than 10%, in part due to a ban on Chinese officials having iPhones. And how long can you continue to grow operating margins to offset declining revenues? You can't do it forever. And Apple is on a P ratio, I think like 33. And so it is not being priced like a utility, which I think it is. And frankly, I think it's a utility which is in decline. So at some stage, I think Apple, unless it can turn its revenues round, is going to fall sharply.
Corporate buyback announcements. And as we know, a lot of corporate buybacks were funded by debt at very, very low interest rates, which made them economically viable and sensible, and also boosted share prices to the benefit of the option holders. And that looks like that process has pretty much come to a halt now with these higher interest rates. And of course, that was a big boost to the rise in the stock markets over the last few years.
Yes, absolutely.
So will the 21st century produce similar returns, i.e. 1,000-fold, to the 20th century? Question.
Well, long term, I think you would want to be long equities, basically. But you see, within that 1,000-fold rise, you have long periods where equities either fall or do nothing at all. You know, that is a 20-year period.
Yeah.
So, and again here.
Yeah.
So, you know, long term, yes, long equities, but, you know, that doesn't preclude periods where, like now, you've got very high valuations, and then it takes, 10 or 15 years for the market to start growing again.
Possibly quite substantial drawdowns in that process.
Yeah.
Have to ride through. So 30% of the Russell 2000 is loss-making. And it says they will need to raise capital. Well, the question really is, will they be able to raise capital?
Yeah. Frankly, I expect more bankruptcies based on this.
Yeah, exactly. 44 companies have now reported, and the S&P earnings per share growth is 18%, which is impressive.
Yeah.
And it's very slightly below the all-time high. So there we are. Factor that into your recession watch.
Well, exactly. I know, but I mean, the thing is, we know it's been supported by the US fiscal deficit, which is now past. That fiscal impulse is past, I'd say.
And sales ex-energy is continuing to fall after the post-pandemic peak, but it's only sort of roughly round about where it ever was.
Yeah.
And the ex-energy quarterly margin is around about 13%, which is pretty good.
Yeah, very high.
Yeah.
Actually.
Yeah. And equity valuations since the GFC have risen, and US equity valuations, but for the rest of the world, and the FTSE is a case in point, they haven't.
Yeah. I thought this chart was extraordinary.
Total outlier. Yeah.
Yeah. So, valuations in the rest of the world have been very stable, but in the US, they've risen sharply.
Yeah. And this is a trading EPS chart for the rest of the world and for the US, and you can see that the US has basically doubled.
Yeah.
Well, it's quadrupled, which the point being that this increase in earnings per share has had an impact on the share price, which is true. So the US companies are performing much better than the rest of the world. Yeah,
I think this is because the US tech have basically established monopolies on, things such as internet search, and they are basically extracting a rent from the entire planet.
And the switch also from, as an example, of Microsoft, and you pay for a license, you pay £25 as it probably was a few many years ago for a Windows license. Now you pay every month.
Yeah, £60 a year or whatever it is. Yeah.
And so it is now recurring revenue.
Yeah.
Whereas previously, so I've got the same PC that I had 7 years ago. The operating system. And what would my operating system be doing if it hadn't been updated? That's the question, isn't it? Probably not a lot.
Yeah.
Anyway, they've changed their business model. Consumer discretionary sector has borne the brunt of profit warnings so far, which is, of course, not what we'd expect from the consumer holding up GDP.
Yes. Yeah, I know. Mystifying.
Yeah, discuss. Economics exam question.
Yeah.
All the data contradicts itself. Discuss. And the proportion of companies beating guidance in the US and elsewhere has fallen sharply.
Well, actually, this is on sales, not earnings. So you get the revenues are starting to fall over. Yeah. And so far, companies have managed to beat earnings by increasing margins.
Yeah.
I doubt they can play that game forever.
That's very true, Keith. And equity is expensive relative to bonds, which I think we sort of know because it hasn't fallen, but bonds have gone up substantially.
And this chart, thank you to Jorit for sending us this. This pause, take a look if you're interested. What it's basically saying is if you model equity valuations based on bond yields, then equities are basically a third overvalued at least. So equities need to fall by a third to bring them back in line with bond valuations.
And the Russell 2000 is in a near record length bear market. So this is a chart that shows the Russell 2000, which is in a near record length bear market. But if you look at the chart, it's basically an unrelenting upward trend. And we've just commented that 30% of the Russell 2000 companies are loss-making. So where to now, I think, is the question.
Well, I think down, frankly, in the next year or so.
And the S&P 500 index seasonality. I haven't seen this chart for a while, Keith, have we? So November and December, jolly good months. So I think the advice here is to go out and fill your boots. Right, Keith?
Well, actually, these are the strongest 2 months of the year, but we've got so much contradictory data. If you believe the Bloomberg economic forecast, they're expecting the US economy to slow quite quickly. And one of the small data points I saw on Twitter is that Walmart this year are not hiring any seasonal workers at all.
All right.
Which they normally hire, hundreds of thousands. And so you could see, actually, that's a slowdown in the US economy.
Yeah.
We'll just have to wait and see. We've been predicting it for so long now. Anyway, thank you, Richard. On to commodities and energy commodities. And it was an indifferent week in the oil markets as the war in the Middle East failed to spread, and some of that insecurity premium came out of oil, which was down 2.5% for Brent, down 2.1% for WTI. Numbers specific to the oil market, well, US inventories continued to fall last week, down 3 million barrels. So the US oil market was undersupplied. Crude production in the US was stable at 13.2 million barrels, a high for the year. And actually, that's 10% growth year on year. Very respectable. The Baker Hughes rig count is rising again, up 2. So this is Europe's expected oil demand over the coming years to 2030. And you'll see that actually that's quite a substantial drop. That's probably around 10% or more. And what that implies is lower refined product demand. And the trouble is that we have a fixed amount of refining capacity. Lower demand means that refinery margins are forecast to collapse because we're going to have an excess of refining capacity that is bad for refiners such as the majors and INEOS. Now, this is Russian seaborne exports. They are cheating again. They should be cutting. They ain't. Now, okay, please.
I don't think the Russians call it cheating, Keith.
I'm sure they don't. So, a plea for information. I have seen this chart on Twitter and I struggle to believe it. So, if anyone has some hard data on European oil demand, please can they send it to us? So this chart purports to show that European oil products demand is down 12% year on year, and demand has been falling every month the last 4 months. Now, the extent of that drop I find implausible, but I've been unable to find hard data. If anyone has that data, please can you send it to us? We do expect oil demand to fall as the European economy slows, but frankly, not to this extent. This would really imply big drops in the oil price in the coming months unless Saudi were to take even more oil out of the market. But in China, over the last 4 months, you've seen actually quite large drops in crude oil inventories. And if that continues, they'll have to increase their buying to support oil consumption. Okay, moving on to natural gas. It was an indifferent week in Europe as we're having warm weather, and warm weather is expected to continue. So Dutch natural gas futures down 3%. UK natural gas futures were flat. US natural gas futures on an upward rising trend, but down 0.3% on the week. Coal, it looks awful, actually. So falling energy consumption everywhere is particularly showing up in falling coal prices, down 70% on the year. Uranium, the bull market's back on, up another 1.4% to a new high for the year. Industrial metals, Richard.
Thank you, Keith. So aluminium sort of bouncing around that to 2200 point. Cobalt, don't really know, not much price data there. Copper is rising again, which is interesting.
Well, so confidence is returning, isn't it? We have bond yields, so rising bond prices, rising equity prices, rising copper prices.
I read again another article. There are numerous saying that there is not enough copper in the world to do what we want to do with green energy.
Yeah, but we're talking about wind turbines. Yeah, green energy, very capital intensive, and actually low margin. So. You'd expect, actually, I think copper could have a bad couple of years until you get interest rates back down to the point where you can start doing these investing long term in these big green energy projects again.
Or the pricing goes up, of course. But
yeah, that's it. Well, as you're on there talking about the green energy projects, the government, the UK government, failed to attract any bids for its recent round of wind farm developments, and it now faces the choice of, if it wants to meet its carbon reduction goals, then it's going to have to increase the prices it offers, which is bad for consumers, bad for inflation. So what's it going to do?
Build a couple of nuclear reactors.
Well, I hope so. That would be the sensible thing to do.
Just no intermittency problem there. Chromium unchanged on the week. Iron ore doing the same thing as copper, actually.
Yeah.
Lithium still at its low, 69% down on the year. And neodymium, it's gone up a bit, hasn't it? It bounced up in late summer, stabilised now. One would expect that to be hit by lack of wind farm production. Now, nickel relentless, steady decline.
Yeah.
Tin is, I would say, unremarkable. Ferrovanadium hit another low the other week, didn't it? Not changed since then.
Not a good chart.
No. Zinc, again, unremarkable. And precious metals. So gold pretty much unchanged on the week, up 9% for the year. And that's how much gold central banks have bought in the first 3 quarters of this year. So central banks are going for it.
Yeah.
They are, I think, to an extent, de-dollarizing.
Yeah, completely agree. Actually, I think a lot of that's the Bank of China.
Yeah. Silver down a little bit on the week. Platinum is having a little bit of a bounce, isn't it? But not strong by any means. Yeah. Rhodium, after that fairly sharp decline, it seems to have stabilized, really.
Yeah, it's going to get dead as a dodo, I'd say.
Yeah. Palladium is looks like it too is on a relentless downtrend. Yeah.
But as you'd expect, actually, if we're transitioning to EVs, we're going into recession, the only use for a lot of these metals is, main use is in catalytic converters.
Yeah, that's right.
Okay, thank you, Richard. On to rates. And good news, finally, for once, we have a whole shift down in the yield curve. So bonds had a good week on the back of an expectations of a peak in interest rates on both sides of the Atlantic, reduced treasury issuance in the US, and also falling ISM. So signs that the US economy is slowing. So that's the UK, US. But again, when you look at the change over the last 6 months, it's been absolutely extraordinary. Best part, actually, over 1% rise in long-term yields. Now, this is market expectations for the outlook for the Fed funds rate. And the market is expecting Fed funds to bottom at 4.25%, which is extraordinary. So the market thinks that the US economy can live with these very high interest rates. The thing is, we have been here before. When you look at the expectations at the peak in every other rate hiking cycle, they also expect rates to stay higher for longer. And then the economy slows more than forecast because there is this negative feedback loop in the economy. And so things don't move in linear fashion. They move chaotically as you get a negative feedback loop and things accelerate or decelerate faster than you'd expect.
It's quite interesting. If you look at this chart, if you look at the downtrend just after 2000, the uptrend at 2004, the following downtrend, and now the uptrend from 2022-3, they have recency bias.
Yes. The other way of looking at it is that our market always underestimates volatility.
Yeah.
And this is the history of the Fed funds rate. And now we appear to have hit a peak in interest rates. Well, previously the Fed has held rates at their peak for as low as 2 months or as long as 15 months. And when they held it for 15 months, the results weren't great. That was the GFC. So let's see what happens. So this chart shows US real yields versus the Congressional Budget Office's estimate of the country's long-term growth potential. And so real yields are now higher than the growth potential. So it would then make sense to invest in bonds and get a higher yield than investing in the real economy. And so real yield is 2.4%, growth potential 1.8%. So the incentive is therefore to invest in bonds rather than real world companies or whatever. So this should mean that the US government deficit is crowding out the private sector. It would be rational to allocate your capital to government bonds rather than to companies. And markets are pricing in a higher chance of a US default, which, is technically impossible, but clearly the market is worried about the rising and unsustainable US deficit and the fact that you have legislative gridlock. We've previously been worried about who was going to buy all those US treasuries and record issuance. Well, the answer is households have massively stepped up their purchases to try and lock in higher rates. And hedge funds are record short. So the bond markets had a rally. You'd expect some short covering to keep that going, frankly. Put things into perspective. The yield on the US 10-year is at 4.8%, which is 50% higher than on Vietnamese government bonds. You have to think the sell-off in US government bonds has just got a bit silly. But despite the recent rally, the kind of upward trend in US Treasury yields remains intact. And this chart is potentially quite a bad one for me because I am assuming that a fall in inflation will mean a fall in bond yields as inflation expectations fall. Well, in the 70s, that didn't really happen. The dark blue line is US CPI, and in 70 to 72, it fell sharply. And in 75 to 76, it fell sharply, but bond yields did not fall much. So it really depends on whether the market believes that long-term inflation is under control. So the big question is, are we going to return to a post-GFC low inflation environment, or have we shifted to a higher inflation environment? We just don't know. Currently, the market is assuming we're shifted to a higher inflation environment. Okay, looking at some charts, this is the UK 2-year. So the market is coming to believe we have seen a peak in UK rates. The 10-year down from its highs, but that's still very elevated. The 30-year really still extremely high. US 10-year decisive break. It looks like it really refused at the 5% mark. This is German Bund, also falling. Italian, that's quite a sharp drop. Greek, now 4%. You get a much lower yield investing in Greek 10 years than you do investing in UK 10 years. Any change to your views, Richard?
Not for me, Keith. How about you?
No, same here. And concluding comments, well, it's been a dramatic week in the equity and bond markets as they rallied on expectation. We've seen a peak in interest rates. Now, the US economy does appear to be slowing, finally, the latest October data, but economists are still expecting a soft landing and US GDP growth to not dip negative at any point in the next year. Okay, Richard, how was your week?
So my week was fairly steady, really, Keith. I'm still doing, making no changes to my portfolio. The fact that gold and silver to a lesser extent have stabilized, gold particularly just below 2,000 is good for my portfolio. I am eagerly awaiting its break above 2,000.
Yes, well, absolutely.
How about you, Keith? I suspect you've had a much better week.
Well, thank you, Richard. I had a much, much better week, but, still absolutely awful. And the truth be told, that the price of UK long bonds are still much worse than my worst case scenario. So, let's put these things in perspective. I've been totally wrong. But I'm highly geared to, bond yields. And frankly, if I just sit with this portfolio getting 5%, I don't have any worries in the world, because this 5% is largely tax-free, because it's all inflation in index-linked gilts. So, I'm still expecting the UK economy to slow, and I just don't think that these rates are sustainable. But, so far I've been totally wrong. So hoping for as the US economy slows, and the UK economy is certainly slowing, and inflation is coming down. So you'd expect bonds to start catching a bid, but I have got a long, long way to get back to flat. But it's been a good start this week.
Good. Well, fingers crossed for you, Keith.
And actually, before you joined, Richard, I was just talking about how the Bank of England was expecting inflation to fall below 5% in the coming month, when October CPI is announced. And last month it was 6.7%. So they're expecting a huge drop. And I was commenting that that's quite a dangerous prediction for them, because if they're wrong, I mean, their credibility's taken quite enough of a knock this year already. And I would not be forecasting short-term inflation with as far as the Bank of England. I might say around 5%, but I wouldn't say below 5%, because even if it comes in at 5%, they're going to look fairly foolish, I would have thought.
Yeah, no, I agree. But I mean, maybe they've got prior knowledge of something that we haven't seen yet.
Well, let's hope they do.
Yeah, fingers crossed indeed.
Okay, that's it. Thank you all for watching. Please can you press like and subscribe to the channel. And it is goodbye from Richard Reuter.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only, and should not be relied upon for making a business, legal, or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website, or to any information, products, services, or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.